Hello and welcome. My name is Joe O'Mara. I'm the Head of Aviation Finance with KPMG. And on behalf of KPMG and Airline Economics, I'm delighted to be joined by James Meyler. James is the CEO of Orix Aviation. He is joining us for the purpose of our Aviation Leaders Report 2024. And I should say we're recording this in late November. James, thanks as always for joining us. Before we get into the meat of the conversation, do you want to tell our watchers a little bit about Orix Aviation?
Thanks, Joe. Thank you and KPMG and Airline Economics for having me here. Orix Aviation were one of the longest aircraft lessors in existence. I think the longest with the same shareholder, coming up on 35 years as a 100% subsidiary of Orix Corporation, which is one of Japan's largest financial institutions listed on the Tokyo and New York Stock Exchange. We have approximately 210 aircraft that are owned and managed, worth about $8 billion. We are very much an active trading lessor and a asset manager, where we're active in the Japanese operating lease market, and also so approximately kind of 2/3 of our fleet are actually managed and the remainder owned. And we're typically we'll buy 40-50 aircraft a year, but actually sell 40-50 aircraft a year. So we're very much a trading company. We also hold a 30% stake in Avalon, of which I'm also a board director. So I think compared to probably many investors, we've both the longevity of being the longest lessor with the same shareholder, but also with our investment and our involvement in Avalon, large order book lessor, number 3 in the world. We probably have one of the, biggest crossovers across the industry in terms of asset management, trading, and traditional order book lessors.
And maybe we'll start, James, around customer performance and looking at the airline environment. Can you talk to us about how customer performance has evolved over the course of 2023 and whether or not you're seeing any interesting trends from a geographic perspective?
Yeah, I think when we look back to this time last year, we were pointing that the US had recovered strongly first, Europe was following, and Asia was lagging behind, but would be expected to follow a similar trend to the US and Europe, which has happened. I think probably the interesting trends that have evolved, apart from the obvious in terms of passenger numbers, are the nuanced recoveries and growth of probably the full service carriers. So in the likes of the US and probably very much in Europe, it's what would have been seen as the traditional flag carrier airlines, the British Airways of the world, and in the US, the big carriers. They've actually had probably the biggest recovery in both, especially in profitability. So they've been able to kind of fill the front of the planes at the premium passengers, whether they weren't necessarily the business passengers, but really the COVID trend of revenge travel and people being willing to spend on experiences has meant that they filled the planes with leisure travelers traveling in business and first. And that premium product has actually really continued very resiliently throughout 2023. And in Asia, I think the business recovery hasn't played through as much. And then equally, the leisure traveler, while it's caught up, they haven't been able, I don't think, to pass on the full kind of yield increases that the West have. So that's been an interesting kind of dynamic. And finally, China, I think, was the one that people had really thought would bounce back very strongly when it opened, which hasn't quite yet. And certainly from a profitability level, 2023 has been very poor really across the Chinese market, in fact loss-making. And while most kind of banking institutions will forecast 2024 will see that return to profitability of China, we're not really seeing it play out yet. So it's definitely a very interesting dynamic across the East-West divide in terms of kind of premium travelers especially.
And maybe if that's where we sit now, as you look out into 2024 and you assess maybe that environment for airlines, where are your thoughts, right? So in terms of, we've come through a relatively unprecedented disruption over the last 3 years. Maybe we're back to dealing with normal problems, if I call them that. But as you look forward and you look at both the geopolitical challenges that are there, the macroeconomic environment, your confidence in how that airline recovery and performance sustains, what's that like?
Yeah, there's certainly both tailwinds and headwinds. I think the headwinds are more normal in the sense of obviously increased interest rates. The dollar strength up until recently has certainly made it challenging. I think while the recovery has been very good, the margins are still thin. Like the average is about $3 per passenger in terms of the profit levels across the industry. So it doesn't take a big increase in the cost base to basically kind of eat into that profit margin. So I think that's the one kind of thing that's going to be a continuing trend, is that to be able to maintain the profit levels that have been seen, cost control is really going to be the big challenge. Some of it, obviously, the labor costs we've seen have kind of, because of the lack of supply of staffing, people who left during COVID, especially in the US market where it's more visible, the union demands and the renegotiated salaries across the pilots, cabin crews, mechanics. So across the board, there's been a very significant increase in the labor cost base, which really is now embedded. The fuel cost is clearly one that's outside of the control of the airlines largely, and it's largely driven by the geopolitical issues, which I'm sure we'll get to in a moment, which are many at the moment. And then finally, interest rates / lease rates are going up, and aircraft values and maintenance costs are going up. So there is no kind of two ways about it for the airlines, that at least 2/3 of their cost base are significantly increasing. And the only one that is potentially going down is oil, but that is out of their control and will be largely driven by geopolitical events. So I think it's going to be difficult, to be honest, for the airlines to maintain that level of profitability with the increasing cost base and the lack of kind of ability to pass on continued increase ticket prices.
Yeah, and a couple of the points you touched on there around asset values and lease rate factors are heavily linked to the supply side. And maybe if we can touch on that for a moment. Interested in your perspective, that one, as a significant trader of aircraft, and two, your indirect holding, you've got an order book, right? Or a significant interest in a very large order book. As you look at, and let's stick with the airframe manufacturers to begin with, your assessment on the challenges that those supply side challenges are having on the market at the moment, maybe honing in on aviation finance.
Yeah, I mean, I think frankly the supply chain and the order book delivery stream is broken, and any hope that there was of having it fixed coming into kind of the back end of the year into 2024 has been kind of thrown out the window with various new challenges like the GTF engine issues and kind of continued certification delays across the Boeing product as well. So really, it's very hard to see. I think when we talked last year, we kind of thought, okay, 2 to 3 years, it would be normalized. I would now say you're probably talking more like 3 to 5 years before you get into the supply chain kind of and the deliveries of aircraft being back to where the manufacturers had hoped they would be, or even have currently said they will be. I think that is now heading out towards 28, 2029. In general, what does that mean? Largely from an aviation finance point of view, both lessors and banks, it's a good thing, because the reality is the airlines are extending aircraft. You know, we, I think in the last 2 years have extended approximately 50 aircraft, which is almost a quarter of our fleet. And that's, I think when you talk probably to everybody else who's been doing these interviews, it's a very common theme that airlines are keeping the aircraft they have because they cannot get the new aircraft from the manufacturers, and they know that if they don't seize the opportunity to keep what they have, those planes will be taken up by other airlines who are trying to grow and can't grow because of the manufacturer delays. So in terms of the leasing programs, the general supply demand issues, the supply is a lot less than had been forecast. Obviously, we know there's 3,000 less planes built over the last 3 years because of the delays during COVID, but that's going to continue to grow by the looks of it over the next, say, 2, 3, 4 years. That's going to mean the airlines will need to keep the mid-life planes flying longer. Aircraft that would have been returned, maybe with balloon debts due, it would have been sold to repay debt, will be extended. The debt terms will be refinanced and extended. So in general, it's probably a good thing for most parties, apart from the manufacturers, basically. And even the airlines in general are, they're actually, those aircraft are coming at a lower cost lease rental than new deliveries. So for a period of time, they will actually have a lower cost base on those aircraft as well, and they will be able to extract more value out of the planes they've had in their fleet for a period of time before they get their new aircraft in. So I think most people will benefit from this other than the manufacturers.
But maybe taking that perspective of an asset manager, as you say, Aaron, it's kind of as you say, a plus and a negative, presumably, in that my asset values are going up, probably tempting, do I flip my aircraft, but can I get access to refill my balance sheet, right? So your perspective as a trader of aircraft in this challenging supply side piece, how are you thinking about that dynamic?
Yeah, and it is a very kind of interlinked world where, in one respect, what we've probably seen for the last several years is the lessor trading has been a fraction of what it was pre-COVID. So I think it was approximately 800 to 900 aircraft in used aircraft traded between lessors in 2018, 19, 20. For the last several years, that's been in the region of 300. So it's been a huge percentage less than what would have been. A lot of that was driven by especially the big lessors who, AirCap, GCAS, ALC, Avalon, others, SMBC, who would have typically sold a very large portion of aircraft because they had order streams continuously replacing those aircraft and growing their balance sheet with the, not even delays, but with almost no aircraft delivered to them during the COVID period. They obviously were reluctant to be trading as many aircraft because they weren't able to replenish that balance sheet. So that was definitely a challenge, and then that kind of caused where there was less less assets available, were being chased by the same number of people, which somewhat drove up the value or the kind of the price that people were paying for these aircraft. So it was a very competitive landscape for the last several years, mainly because of a lack of availability of trading aircraft. What's probably shifted now is the balancing act between going to market to fund debt as a large lessor, and obviously the bond markets, while they're open, the rates that are available are not particularly attractive, especially if you do believe that interest rates will fall within the next couple of years. Locking in 3, 5, 7 year rates at today's market is something that, generally speaking, certainly on a large scale, the lessors have sought to avoid. And therefore they've looked to kind of capital recycle and sell aircraft to fund their new deliveries rather than go to the bond market or the debt market to fund new deliveries. That's then put more supply into the market, so it's a more healthy supply demand. There's not too many in the market, but there's definitely more aircraft this year for sure in the secondary market than there was last year, largely I think driven by the big lessors using trading as a tool to help fund capex.
And maybe honing in on the interest rate environment you brought up there, we knew last year rates were going up. It was probably the scale and pace at which they went up that were probably the most challenging element. Seems to be a general consensus we're in a higher for longer period. Can you talk to us how you're thinking about that in the context of aviation finance, and maybe linking that to lease rate factors, which you touched on, where it seems as if that lag is catching?
Yeah, and look, obviously, as I said, Orix is 35 years doing this. We've seen interest rates much, much higher than they are today. And actually, where they are today is at the lower end of the average. The last 10 years, obviously, have been particularly low. But there's no question the pace of the increases last year were really what made things difficult, really, where it was from month to month, you kind of thought you were planning ahead in terms of if you were issuing debt, and all of a sudden next month it's gone up higher again. So I think, and it was very difficult to pass that on quickly to the airlines. For sure now, what you have is that the airlines have seen that they kind of higher for longer. They've seen that the rates are genuinely kind of costing the lessors and themselves in terms of if they are going to market. So most airlines will be obviously weighing up options like double ETCs if they're US, or their own debt market, or indeed the sale and leaseback market if they're financing, or if they're looking for replacement aircraft. they are seeing a very similar story from all of the lessors, where the interest rate being applied to the lease rate calculations are very, very similar, and they're now kind of, I think, accepting that ultimately they do have to pay more, basically based on the increases in interest rates. And that lease rate factor increase is very much has kicked in for forward order placements, because again, they were quite kind of scientific, and they've been linked to a base interest rate, and as that interest rate has moved, the lease rate has moved. The planes are maybe delivering now or maybe delivering next year, but those planes have locked in that increase in interest rates. Sale and leasebacks has been a little bit of an anomaly for a while, in that because of the kind of what I mentioned before about the availability of capital and less deals available in the marketplace for lessors to play in, has meant that there's a very competitive dynamic there, that people are kind of, because of a competitive dynamic, offering lease rates that aren't necessarily commensurate with the increase in interest rates, dollar for dollar from what they did 2 years ago, let's say, to what they're doing today. They are trying to pass on those rates, but it's still a competitive world. So we're seeing, certainly, I think the placement rates have moved significantly. The sale and leaseback rates are moving, and have definitely moved up from where they were, but they're not dollar for dollar where they should be, based on, let's say, where something was done 18 months ago.
And is that just an overhang of capital? Is that people buying market share? What are your thoughts on that?
Yeah, I think there's a few, it's just that there are certain funds, for example, that actually locked in debt rates that on average are quite attractive. So they're not borrowing in today's money to fund those deals. They actually had locked in the money over the last year or two. So those people actually are doing deals that are dollar for dollar more profitable. But if you were going out and raising new money today and trying to do some of these deals, I think that basically the only reason some people might be doing it is for market share and kind of a loss leading to get them in the market presence for a future long-term play. But I think and some maybe funds who have raised money with a drop dead date that have to be deployed are kind of coming to the end of that investment period and are doing the best deals that they can find in the marketplace, that are not necessarily where they'd like to be, but again, in terms of a longevity, they're acting now while they can.
And maybe just stepping back and looking at the debt market more broadly, so we're in a higher interest rate environment. The availability of debt capital, so as you look across the traditional aviation banks, maybe the IG rated lessors playing in the unsecured space, and the probably rising influence of the alternative lenders. Your perspectives on the health of that market as a whole, on the availability of debt, noting it's at a much higher rate.
Yeah, I actually think the health of the debt market generally is excellent. It's a much broader base now than it may have been. You have the traditional lenders who are still hungry, active, who have maybe they're slightly more kind of focused on more vanilla type deals, better credits, for example. But with the proliferation of the alternative lender space, mainly backed by kind of private equity firms using either funds or probably more likely insurance money that are within their remit, those have given a kind of a much broader availability of kind of on the spectrum of deals. And then the bond market again is very much open, albeit at relatively speaking, all in an expensive price. The margins actually haven't moved hugely. It's just the base rates have gone up. So I think the reticence people have is while people have talked higher for longer, they're very kind of quickly is coming noise that actually interest rates may be forecast to drop as soon as next, kind of 2024. So I think people are reticent to lock in today's rates more than kind of a token amount of funding than to try and kind of guess the market essentially that interest rates are going to keep rising or stay higher for longer.
Yeah, do what you have to at the moment.
Yeah.
And maybe flipping to the investor side, your perspectives on the health of that market. Obviously, and maybe honing in a little bit on Japan as we chatted through. You mentioned, very active in the JOL space. Can I get your thoughts on the health of the investor market? And sometimes you look at aviation and on a stand-back basis of last 3 years and go huge levels of resilience, clearly, right? And the lessor business model even more so. While on the flip side, have felt outsized impact in relation to COVID or in relation to Russia. Where do you think that market sits now?
Yeah, I think there's pretty healthy appetite for the space. I think certainly the resilience that has been proven time and time again, essentially through crisis after crisis, that because it is a dollar asset, because it's a mobile asset, and because ultimately you can move it from place to place, and we've all the successful quality asset managers and lessors like Orix have proven the ability to move planes around in challenging times, means that there's definitely an acceptance of the kind of the mainstream investment class that it is. The challenge clearly is basically the alternatives that are available, or the relative value that may exist now in certain either risk-free investments or US government bonds, investment grade corporate bonds that are now trading in kind of high single digit returns with very, very low risk and very, very good liquidity. That kind of, I think, passes on a challenge really for the not just the aviation kind of leasing industry in terms of returns, but many other asset classes, essentially, where there needs to be a kind of enough margin or spread above these lower risk returns to kind of just to compensate for the fact that it's a relatively illiquid asset. You are somewhat obviously subjected to maybe not cyclicality per se, but certainly to the geopolitical risks that are very much outside the control of the investor base. So I think that's certainly playing out, that people are looking for basically a higher return. But I think also people are seeing that you've got a very, very kind of good chance of a much higher residual value into the future than may have been forecast, ultimately because of inflation. So inflation has really, as you know, become embedded, especially in the maintenance side of aircraft. So the life limited parts, many of them have increased on average 10% for the last 2 years. And that kind of compounding of high single digit or even double digit increases in maintenance cost is real, and that eventually will be returned to the investor when they either sell the plane for part out, or indeed they get them where the airline pays the return compensation rate for the life that they've used on the plane. So that inflation, I think, is also kind of in people's minds as that there is actually significant upside maybe from where they're pricing deals, assuming that the world continues to perform strongly and there's demand for aircraft to be flying. Then I think you can see higher residuals coming people's way. So,
and coming back to maybe the Japanese point then on the JOL market, seems like the appetite is there clearly for I think tax relief's like a drug, right? You have to keep topping it up, and that has come very strongly demand side back. Can you talk to us about the challenges that the dollar volatility with yen is putting into that market?
Yeah, and ultimately most of our investors, and we typically do single investor deals where they are long-term investors both in aircraft but also in kind of looking for a return beyond the tax benefits. So they're looking a bit like other people at the alternatives that exist in terms of risk-free rates, but also the yen certainly does play a part where it's I think as we speak it's strengthened a little bit back to maybe 148. It had been 152, 153 last 2 weeks ago, but a year ago it was just over 100. So that's quite a sizable movement, that a bit like kind of the lessors going to the bond market and being afraid to lock in longer term higher rates. Similarly, like any investor, if you believe it might be a short term movement in the currency, you're going to wait and see, and it comes back in your favor. If it's more normalized that it stays at this for a longer period of time, then I think people will essentially need to move to put their money to work, even at the current exchange rate being less favorable than it may have been. But there's also two sides to the coin. We have many of our investors who are have multiple aircraft built up over the years. They're all dollar aircraft that they've bought over the last number of years, which are now worth significantly more in yen terms. Their dollar income is also coming in every month. So it's really only for if it was a first time new entrant to the market who's converting yen to dollar for the first time, that obviously is the biggest, most stark effect. But there's not that many of them, or there's not that many of our clients that are not already invested globally, maybe in the shipping world with a dollar income, or indeed they have many overseas investments as well. So most of our client base would tend to have a pretty kind of diversified, if not dollar, at least overseas income stream. And many, if not all of our investors already have multiple aircraft, which means they have benefited from the move in the dollar on balance, and then it's really about a timing question as to when they may make the next investment. But the fundamentals, I think, that they've seen through COVID, for example, where we've typically focused on good credit airlines. We had much less default than the average across the lessors in our fleet. Most of our JOL investors were paid during the lease term. So basically they've seen both the resilience of the space and the benefit of a quality asset manager like Orix, who've been able to act where needed. So I think the appetite is certainly there. It's probably a timing question now, as the currency has been quite volatile, quite quick. Similar to interest rates, it's that pace that it moved has kind of caused discomfort rather than maybe the long-term movement.
Yeah, fundamentals there, as you say, the volatility, the challenge. And maybe looking at the macro leasing environment, and an area we've touched on, James, over the years and having this conversation, is that the share of the market that lessors hold on a long-term basis kind of ticks one way. And COVID has probably accelerated that tick upwards, and funding maybe mid-50s of new deliveries as airline balance sheets were stressed. As we reach an environment where some airlines are generating a significant amount of cash, do you think that starts to recede a little bit? Or do you think the fact that you deepened relationships with airlines over the course of the pandemic and they enjoyed the flexibility that leasing could offer, that long-term trend will continue?
Yeah, I think I've probably been pretty consistent over the last, I don't know how many years we've been doing this, in calling that actually I think that it's going to continue to increase to 60% and maybe even continue to climb. As I've said before, the biggest hotel group in the world doesn't own any hotels. It's brilliant at operating them. Somebody else has the ownership, risk and reward and management. And I think actually a lot can be said for the same for aircraft, where airlines themselves would be a lot of the time better served to have the lessors manage that process, and that they essentially do their thing, which is flying passengers around and trying to increase load factors and the yield that they get on those passengers. So I certainly think that trend will continue. I think for sure what we've kind of seen with COVID has shown both the benefit and the kind of the challenges, especially from the manufacturer, in terms of where they have the orders placed. And I think there was some possibly overspreading of orders to lessors, where I think it is a very bespoke and market to be an aircraft order lessor is very different from being a trading lessor, or it's very different from doing occasional small orders, that you need an entire infrastructure and expertise that you can't really dip in and out of. And I think the manufacturers saw that during some of the challenges of COVID, that the large expert lessors in orders such as AerCap and Avalon, SMBC and the likes were able to handle all of the scenarios that came their way, whereas perhaps some of the lessors that may have been first-time orders or had very small order positions found it very difficult and challenging in that environment to be able to manage the process, but also to be able to get the returns that they were looking for. So I think you'll see the manufacturers shift to a smaller number of lessors in terms of where the order book is spread, but I think you'll see a massive increase in the sale and leasebacks being done. So if you look at all the very large airline orders that have come in the last couple of years, very large scales in India, obviously with Indigo and Air India, but also now in the Middle East, the continued ordering of Emirates and Etihad, but now you've got large Saudi entrants. I think those airline orders will very much be filled by sale and leasebacks, at least 50%. And then if you have maybe 25 or so percent going into the lessor channel from the manufacturer as well, that's how I see the kind of the shift continuing. And what kind of, while there are certain airlines for sure, like Ryanair and Southwest, who have generated enormous cash and have basically no debt on their balance sheet, they may well not have much in the leasing channel, but they're again a very small percentage of the global fleet and order book. So I think you'll of course continue to see a few of those type of carriers that will have limited leased fleets, but I think you'll see the majority of those big ordering airlines like United Airlines, Indigo, and likely the Saudi new carriers, I think will do quite a very significant amount of leasing.
Yeah, and maybe keeping with the leasing market and maybe the theme of consolidation, if we look at what's happened over the last 3 or 4 years, there's been some theme around who's been bought, right? It is that maybe 100 to 150 aircraft carrier where you think AMCK, Goshawk, Standard Charter. Is that a theme you see continuing where that, used to be large, now it's probably mid-size with that $3 to maybe $6 billion size balance sheet? Do you see that being the area that drives consolidation? And then I might pick up separately in the asset manager, but maybe take that point first.
Yeah, I think M&A and consolidation will continue. It's been there since this industry started over 40, 50 years ago, and largely actually because of the success of the companies. So funny, in general, what we've seen is it's been actually a sick parent rather than the sick child that has caused the M&A transactions, where if you look at RBS Aviation days even, and obviously now probably similar with Standard Chartered, where it was the parent company's requirement to either restructure or raise financing or release equity meant that they could turn to one of their star pupils, which is the aircraft leasing business, to get an international trade away at very significant scale. So there's not been any, if really I can think of, that are actually where the leasing company wasn't performing financially well or wasn't performing that has driven the sale. It's actually been a kind of the shareholder stroke parent company that has decided that it needed to sell. And it's proven that it's a very liquid asset, that you're able to sell these platforms and their very large billion-dollar positions relatively quickly. So I think that's actually a very big positive, that as money comes in and out, there will always be certain shifts in either banking policy in countries or a bank's own policy or whatever might drive it. And I think you'll see those companies being sold. There's obviously certain companies are essentially set up to be sold, where, kind of a private equity type model where they have an investable period, 5 to 7 years typically, where they buy in and they want to get out within that period. So they'll continue for sure. And they tend by the nature to have not delivered, not got that big within that period of time. But I think fundamentally, if you look at probably the top 10 lessors, almost all of those leasing companies want to get bigger and buy somebody else. I don't think there's anyone in particular that doesn't want to get bigger or wants to sell. So I think that's a big part of the reason as well why you're not seeing mega kind of lessor M&A, is because each individual of one of them has their own ambitions to get bigger. And one of the only places then that they can acquire is in that kind of next phase of 10 to 30 in the top 50 lessor space, who are in that 100, 150 aircraft positions. I think if any of the top 10 were for sale, I think you would see a bigger M&A, and I think any of the top 10 would be keen to buy them up.
And maybe focusing on the asset manager class, because one point you mentioned earlier, the trading environment is more challenged. You talked about that reduction in trading. Getting your supply side is challenged, right, which is feeding into that on the asset piece. We've seen very little asset manager consolidation, right? I think maybe Ergo Seraf, right, as an example. Is that something that we could see more of, like in a case where building out your assets under management is just more challenged in this environment, and on that basis it makes sense maybe to see some consolidation across that space?
I think there's certainly an appetite for it. there's probably a question mark about the viability of doing it, where typically they're typically owner managed entities where they've built up a very good business. It's a very relationship driven business. You've got to first of all figure out obviously how transferable that business is long term, especially where typically asset management platforms trade at quite a large multiple, typically in the mid-teens certainly. So that of revenue stream. So you've got to be, if you're paying that type of multiple, like kind of 15 times forward earnings, you've got to be sure that it's going to be doing the same earnings at least for 15 years, but really you've got to be where is that growth going to come from? The synergies on SG&A are probably limited because as you get bigger you need more people, so there's probably very relatively small synergies on SG&A across the asset management platforms, and you're paying up for a future income stream. So as I say, I think there's appetite for sure, but I think the price point that makes it attractive for the buyer is pretty far away from what makes it attractive from a seller.
Yeah, so the economics being the key blocker. Maybe just touching briefly, James, on the environmental challenge, right, and really framing this in aviation finance. So very curious as to when you're talking to either raising debt or talking to your shareholder or other investors, how high does the environment come into those conversations?
It comes up all of the time, essentially. We're obviously talking about it all the time or thinking about it all the time. There's no question on that. It always plays a part in terms of everything you're doing. Whether or not you can do anything necessarily to change a decision is one of the challenges we face as an industry, where we know we have to get to net zero. We know we need almost every one of the technologies to come in. Obviously you need SAF, but you also need electric, you also need hydrogen, you need everything together, plus probably new aerodynamic airframes, plus enhanced engines. But as we've seen with what are relatively small steps in the engine improvements over the last number of years, the 15 or 20% with the new technology engines, and the problems that has caused in terms of reliability and issues that I've no doubt the engine manufacturers will resolve these current issues, but it does highlight how far can you push the technology, or how quickly at least, without actually essentially losing the reliability and that's been so prevalent both in the engine side, and obviously we've seen the same with Boeing with their new technology product, both the 787 initially and obviously the MAX, that every time you take that shift, it does cause teething problems, delays and reliability issues that take some years to solve, and that's with moves that are in the 10 to 20% range. We need ultimately moves to get to the 80-90% range, which just highlights it's got to be incremental. And it's going to take time basically to get there, to actually allow the technology to catch up and allow the reliability issues that have been plaguing really the industry not to become detrimental to the actual flying public, essentially.
Maybe in closing then, James, as you sit here in late 23 and you're looking out into next year, considering the aviation finance space and maybe the sector more broadly, what are your optimism levels like?
Look, they would be very good. I mean, certainly given what we've come through. Now, I think I've probably many years we've sat here and said similar, and then by February they've been torn apart by black swan events or things that are beyond our control. So it's a dangerous question to predict. But I would be positive that actually, I think 2024 will be a year of a kind of stable normality, maybe, which we could do with. It's been a while, rather than anything spectacular. The challenge clearly is more likely on the geopolitical side, where I don't think we've been in a period of time where there's more, for a long time since the world's been so fragile in terms of either wars ongoing, like in what's happening in Israel and Gaza, and also obviously what's been ongoing in Ukraine. So these are things that should they escalate, obviously will have a big impact on the aviation space, because it is about connecting people, moving people around the world. also as we talked earlier about the oil price part, is really the last piece of the jigsaw in a way for the airlines that has a potential to go down, but also if there's escalation in any of these kind of global conflicts, will drive oil prices to a higher level and will put even more cost pressure on the airlines. So as I say, definitely optimistic, because I think the traveling public want to travel. The kind of financial markets are actually performing very well. They're strong for the leasing companies. The interest rates kind of stability will kind of embed and play through. So generally positive, with the caveat of the kind of geopolitical issues that could have a knock-on effect to both profitability and yields and travel generally.
Well, James, thanks as always for your insights. And on behalf of KPMG and Airline Economics, we wish you and Orix Aviation a very successful 2024.
Great. Thanks, Joe.